Stocks drift lower after the US Treasury Secretary Janet Yellen rules out a backstop for all banks' deposits. Even as the Fed Chair Jerome Powell tempers rate hike expectations, IT is a big drag on the index today, while utilities and autos eke out gains.
The hike in gas transmission tariff is positive for the gas economy, GAIL tells CNBC-TV18, even as it wants a review of the hike. City gas players IGL and MGL say they will hold prices till a decision on the Kirit Parikh panel recommendations is made in April.
The government floats an offer to sell up to 3.5% of its stake, over 75% stake in Hindustan Aeronautics at a discount of a little under 7%. The stock slips on the discounted sale.
Hero MotoCorp will up prices of its two-wheelers by up to 2% from April 1 to cope with higher costs of meeting regulatory norms. Even Eicher VECV tells CNBC-TV18 it is weighing a hike of 2 to 5%.
So watching us here on a fresh new edition of Halftime Report. It's midday and, mid-session. It's still indecisive for the markets. The Nifty opened with a sharp cut. Today's low has been protected. From there, we've seen a near 100-point rally. But around the flat line, there has been some sort of jitters, so to say, the inability to go past that 17,180 odd mark. So we'll watch out for how that pans out on the frontline index in particular, as we have the expiry playing out in the second half of trade as well. But the mid-cap index is underperforming, Sonal.
Oh, yes, it is. It is, but still in the middle somewhere, right? It's off 88 points from the lows, but down 85 points from the highs of the day as well. But that particular index continues to be in focus because it is underperforming, as Magnum said, the broader markets as well. So not a big impact that we've seen of the overnight cues. We saw markets decline in the US and in the Asian markets as well. So at least we are at the flat line right now and have seen a recovery as well from the lows. So we'll be tracking that for you. But with that, we'll also go along and talk to a lot more companies and talk about stock specific action as well. Developer Arvind Smart Space is in focus. The stock is nearly up 21% in last 1 year. We've been talking about what the demand on the ground is as far as real estate is concerned. The real estate major aims to launch 1 to 2 projects every quarter and is also targeting sales higher than the usual number, and 800 to 1,000 crore rupees of capex towards land addition as well. Kamal Singhal, who is the MD and CEO of the company, is joining us now to discuss the demand trends and the outlook going forward as well. Mr. Singhal, good afternoon. Thank you so much for joining us. Well, quarter 3 was a strong quarter. How has quarter 4 been so far? We are towards the end already. Will it be better than quarter 3? Will you be able to do sales of around 800 to 900 crores this year itself?
Yeah, quarter 3 and the numbers up to quarter 3 have been great. We have seen great amount of traction in everything that we're doing, from fresh sales, bookings, launches, etc., etc. And we are hoping that this momentum will continue into Q4. We don't provide specific guidances on the numbers per se, but we've been growing at a rate of 30 to 40% over previous years every year for the last few years and quarters, and I hope we should be able to maintain this growth rate in the coming quarters and years as well.
All right, and you were targeting what, 1-2 project launches every quarter. Have you done that in the fourth quarter as well?
We should be able to, yeah. Of course, we should be launching one project in Q4, and that track record should be maintained, yes.
So you haven't launched any yet. The last 1 week that we have, we will hear a launch from you, right?
Yes, correct. There are restrictions on data and everything, so specifics can't be disclosed, but we should be able to maintain our track record of launching at least one project every quarter.
Okay. Mr. Singhal, this is about projects. I wanted to understand your land acquisition strategy as well, because that is something that you're planning. You've earmarked around 800 to 1,000 crore rupees for that. Over how many years will you be spending that? Will you do it via geographical expansion? Also, are land prices also seeing a difference? Are they declining or are they rising? What is the trend here?
So on deployment and the magnitude of deployment, as you are aware, we have a 900 crores of platform with HDFC. where 600 crores are coming from HDFC and 300 crores we are investing. Apart from that, as we speak, as of December quarter, we were zero debt company, rather negative debt existed on the books, and hence we have to take it to a reasonable level. So all put together, we are looking at an investment of in excess of 1,000 crores, and that we said in the last September quarter that it should be deployed in 2 to 3 quarters, and we are on track on that, and we should be able to deploy this 1,000 plus crores in next maybe 1 or 2 quarters from here on. So that's one thing. On expansion and where to invest, of course, we are focusing on our existing geographies of Ahmedabad, Gandhinagar, Bangalore, and now we are trying to get a few things going in Pune and MMR market. Beyond that, we are not looking at further geographical horizontal expansion, but we see quite a bit of scope of penetrating deeper into the existing markets itself, and hence we'll continue to focus on these markets in near future.
Okay.
On prices, yes, land prices have gone up to a certain extent. That reflects the buoyancy in the market overall and the industry overall. But I think volumes and traction and the buoyancy in the demand, etc., all put together, things are fairly good, and the momentum continues overall.
Okay, so two-part question then. What about the 800 to 1,000 crore land acquisition price kitty that you have? Because land acquisition prices have increased, do you think that will put a spanner in the works of your, expected sort of volume that you wanted to make by acquiring land? That's point number one. And secondly, collections. The third quarter, we saw almost 170 crores of collections. Fourth quarter, is that run rate likely to continue?
Yeah, run rate continues. Of course, collections are healthy. We should be able to achieve a very healthy growth over collections last year. We are on track and we are doing fairly good on that and very confident about that. Increase in prices does not necessarily mean that it will have an impact on our overall plan and scheme of things. In fact, we are also going very, very strong on joint development model. Development management model here. Our overall strategy of acquiring project is a mix of three things: TDM, JDs, and outright purchase. Outright purchase, of course, gets impacted by higher prices. But what we see here is that with every increase in land price, we have been able to pass on a very significant component of cost increase into the market, and hence overall viabilities and volumes, etc., are not getting impacted the way one would have generally taken it as. So we are very confident that we'll be able to achieve the numbers. Volume and value growth will come, and with a combination of JD, JVs, and outright purchase, overall it's supposed to be a very healthy mix, and we should be able to show a fairly good growth in numbers.
Okay. So, Mr. Singhal, these expansions that you're planning in MMR or Pune, will it be high-ticket projects or will it be mid-housing for now? And also wanted to understand what's the outlook on demand, because we were speaking to some other players. They did say that the hike in rates that we saw from the RBI did impact a certain section as far as the housing segment is concerned. Is that something that will hurt sometime, if not now?
So we are not in any ultra luxury segment. We don't target Mumbai as a market where you look at 30, 40, 50,000 rupees per square foot kind of a product. We're more like a 15 to 20,000 rupee per square foot market. That's what we will do. We have done this market and this segment in all other markets like Bangalore, even in Pune, we've done very similar kind of market. Ahmedabad also we cater to this, and now of course we do a little bit of a luxury as well, but generally we are focused on mid-priced and higher mid-price, and that's what we will continue to do in MMR as well. So that remains our focus. Maybe if you could repeat the second part of the question, that would be great.
My question was the impact on the mid-housing or the lower housing segment, because we had spoken to other developers. They said not so much for luxury, but there is an impact on that segment. Do you concur with that?
Yeah, lower segment, I would agree that there will be a more direct impact because EMIs hurt that segment more, and when the interest rate goes up, of course, it will have a bigger impact. But when it comes to mid and upper mid market onwards, and especially in luxury, it has a very, very minuscule or a very small impact there. One, because there is a scope to resize, there is a scope to relocate. You could go a kilometer further down if there is an EMI constraint, etc. Because there is a scope. It's already mid and upper mid segment that we're talking about. For the lower segment, these scopes are very limited, and hence it has more impact. Fortunately, we are operating in a segment which is starting from upper mid onwards in most of our markets, and hence we don't see very significant impact. We did have one project historically, which was ultra low, 20, 30 lakh rupees onwards, and we did see an impact coming on that segment. But as you're aware, we are focused very clearly on mid and upper mid onwards kind of products, and there we don't see significant impact of whatever has been happening in the last few quarters on interest.
All right, final question before we wrap things up, and this one we expect you to answer very quickly. Mr. Singhal, what exactly is the current portfolio that you're sitting on? What's the revenue potential from that portfolio? That's point number one. And secondly, with all the expansions that you've announced, what is your future, inventory target?
So we are right now executing around 17 million square feet, and 8 million odd square feet is about to hit the market, various stages of approvals, etc. So all in all, 25 million square feet is our portfolio. A lot of it is horizontal townships and plotting projects, so to say. And with this 1,000 plus crore rupee investment which is lined up for the next 1 or 2 quarters, every 1,000 crore gives us, depending upon product category, etc., it gives us 3,000 to 5,000 crore rupees of top line. So that's something that we will be adding in next 2 to 3 quarters also.
So this 25 million square feet has revenue potential of what?
So today we will have a unsold inventory of around 3,000, 3,500 crores. And we should be adding, based on these further investments of 1,000 crores. The normal change could be, the normal data could be every 1,000 crores should give us 3,000 to 5,000 crore rupees of top line, depending on what product you give. Of course, margin will have a sanity, will have some sort of a uniformity, but suppose it's a product like plotting, it gives less of top line and more of bottom line. That way it varies from 3,000 crores to 5,000 crores.
Okay, all right, Mr. Singhal, it was a pleasure speaking with you. Thank you so much for joining us. That's the word coming in from Arvind Smart Spaces. With that, we'll slip into a short break now. On the other side, in our special segment, Inside Edge, we put focus on the gas economy. GAIL, IGL and MGL will be on our focus. Stay tuned for that. Welcome back. You're still tuned into Halftime Report on CNBC TV18, and this is our special segment Inside Edge. Today we are going to be focusing on the gas sector, or the gas players, so to say, because yesterday during market hours we got the news that GAIL's new integrated natural gas pipeline tariffs are hiked by around 45%. Now it is set at 58.61 rupees per MMBTU. Remember earlier PNGRB in its concept paper had said that they will be proposing a tariff of 60.9 rupees per MMBTU. GAIL actually had asked for a 70% hike. So of course it's lower than that, but nevertheless it is in line with what the street was working with. We got some brokerage views after this big announcement because it is a big positive for the company, where Citi said that integrated tariff hike should put to rest skepticism around regulatory upsides, that yes, nothing, the skepticism around what the PNGRB will actually go ahead and do with the company's tariffs. Jeffrey says that they see a 17% EBITDA increase in FY24 for this transmission hike that has come about, with part of the benefit offset by higher operating costs, which the company will see. Morgan Stanley says that this implies an increase of 2,000 crore rupees in terms of revenues, and will also lead to 14% hike in EPS in FY24 and 12% in FY25 as per the estimates that the street has. JP Morgan says this tariff hike and lower spot LNG prices are a positive. However, earnings will continue to remain volatile. Motilal Oswal says that they have increased their EBITDA estimates to 13,400 crore rupees versus 11,600 crore rupees. This is for FY24 on the basis of this tariff hike. In fact, we spoke to a whole host of players, GAIL of course being the biggest one there, and the users of gas as well. So let me start with what GAIL told us. They said at current volumes of 107 MMSCMD, this additional tariff could bring additional EBITDA of 1,600 crore rupees. And right now, in Q3, they did 107. Last year, they did 111. In FY24, they will be able to do volumes of 121 to 124 MMSCMD, which would mean even higher EBITDA at higher tariff. Then we spoke to the users, basically, who get this transported gas for their own use as raw materials, IGL and MGL. So let me start with MGL, where they said that it will be a gain for some and a loss for some, depending on which area or geography they are. But any tariff hike that will come by will be passed on to the customers by MGL. However, IGL says that while input gas costs will go up by 80 to 85 paisa per SCM, they will not pass on the price hikes to the customers, and also they are awaiting the final outcome of the recommendations that the Kirit Parikh committee made. So whether that comes about or not is something, Mangnam, that they will be watching out for, and that is the decision that they will take going forward, whether they will actually go ahead and pass on the price hikes or not.
All right, you gave us an edge into the insight. Let's get that insight as well. We spoke to the users of gas, GAIL, IGL and MGL this morning, and this is what they had to say.
We are examining the order and we will go back to PNGRB for review of their tariff order which they issued yesterday. So it's a very early reaction, because we have received yesterday only, and these early study suggests that certainly we will approach to PNGRB for review of tariff for upward revision. PNGRB has notified the tariff for 9 of our physically interconnected pipeline. If you see the weighted average tariff for those pipeline currently is around 46 rupees per MMBTU, which has been increased to 58 rupees 61 paisa. That means there is an increase of 26% for these pipelines, and this increase will result into increase of our revenue and also the EBITDA by almost 1600 crore rupees per annum, only based on the actual volume flow being done by us. Based on our computation, we are likely to earn around 3500 crore rupees from gas marketing in financial year 23-24.
For some customer it will be a gain, for some customer it will be a loss, depending on where they are situated. It will definitely be a pass through, because tariff, there are two ways to look at it. One is that some of the gas we consume for internal consumption, so that has to be consumed by us. For some which we can pass through, this is a sustainable, continual basis, so we can't keep it on our books. It has to be passed through. If it increases, we have to pass through. If it decreases, we have to pass through.
So we are also yet to receive the final impact on IGL, but our preliminary analysis reveals that the input gas cost will go up by say 80 to 85 paise per SCM. And we don't have immediate plans to pass it on to the consumers, because we have not increased the prices for long in the past. We will review these prices as and when Kirit Parikh committee recommendations gets implemented. In case PNG, this Kirit Parikh committee recommendations are implemented as recommended, I think there will be reduction of around 1.5 dollar per MMBTU.
Okay, that is a 360-degree view and coverage on what's happening in the gas economy right now. With that, we'll slip into a short break. When we come back, Ashish Kyal of Wave Strategy Advisors will join in with some trading strategies. Stay tuned for that.
Welcome back. It is midday and the markets are in middling ground, so good time to get in what's taking place in the F&O end of things. You know, if you just take a look at the way the Nifty has recovered from the lows, today's low on the Nifty is extremely important. We've been talking about how, you know, the 17,000 to 17,050 mark would be a bit of a support given the option writing that we've seen at levels. And today the Nifty bounced back from that 17,045 mark itself, up more than 100 points from the lows. But at the same time, it is facing some sort of resistance over levels of 17,180, 17,187. Yesterday's high on the Nifty was 17,207 as well. The Nifty Bank is an important index to watch out for. Why is that? Because, well, it it conquered the 40,175 mark, which is the 20-day moving average today, but found some resistance there, even as it is above that 200-day moving average of 39696. Were the Nifty to follow the footsteps of the Nifty Bank and go conquer the 200-day moving average, we'd have to see a rally all the way up to close to 17,500 mark. Whether that happens or not, the question remains in how the FII shorts behave, because they are at 7.5%, a historic low. Today's recovery has given bulls some support. The 17,100 put as well as the 17,000 puts, both of them have seen a fair amount of writing. So the 17,100 put comes up for you, almost 1.3 crore shares added for a premium of 13 rupees, telling you that levels upwards of 17,050 would be a fair amount of support. At the same time, 17,000 put writers too extremely active, believing that that psychological mark will hold on. But its inability to cross past that 17,200 mark has had the call writers excited, and we've seen 1 crore shares being written at the 17,200 call as well. So telling you that levels upwards of 17,200 may face resistance. However, with the caveat that were we to sustain at higher levels for a bit of a time, then these call writers will have to cover their positions, and with the FII shorts, we could see a more powerful short covering rally only if the Nifty holds above yesterday's high of 17,207. So let's see how that pans out. That's the setup in the FNO space.
Okay, whether that ties up with the technical outlook or not, let's get an Ashish Kyal of Wave Strategy Advisors joining us now on the show. Ashish, of course, our markets have seen some recovery, but it's been very range-bound and very indecisive, as Mangla was pointing out earlier. What is now the call on the index and your individual technical picks?
Hi, afternoon to you and all the viewers. If you look at Nifty, very interestingly, yesterday we saw Dow Jones crashing by around 530 points, but Indian markets went down in the opening tick, but managed to recover nearly more than 100 points from there. So that's a resilient sign, and I would look at it like a positive traction from here. 17,200 is seeing some very heavy call writing happening, and that's only 40 points away. So if Nifty manages to cross that 17,210, 17,220 levels, then I think there can be short covering taking prices towards 17,400, 17,420 levels. So I'm going to be bullish given the outperformance that we are seeing. And very interestingly, one more observation on Nifty is that since 16th of March, we have not seen a single close on Nifty below the prior candle low. So below prior day's low, we have not closed. We are protecting the lows on a closing basis. And from 16th of March, now that's also a sign that we are showing some kind of a recovery on the upside, maybe a pullback, short-term pullback, but I think 17,400 levels can be seen on the cards. Having said that, the first stock pick on the buy side is going to be Sun Pharma. We can clearly see some outperformance coming from Dr. Reddy. Sun Pharma now looking like breaking out on the upside. So long positions can be created in Sun Pharma, keeping a stop loss of 945 for the target of 1,050. And the next stock on the buy side is going to be SRF. Again, the stock is showing a very good breakout on the upside. It has managed to cross about that neckline of head and shoulder pattern, and the target of the same comes to around 2,560. So long positions in SRF can be created, maintaining a stop loss of 2,300 for the target of 2,560.
All right, thanks a lot for that, Ashish. With that, we'll slip into a short break. As we do that, here's a quick reminder. Don't forget to join us live on Facebook and Twitter at 2 p.m. today, where our digital offering, a new digital offering called Who Moved the Market, will play and air out. We'll be speaking with Nilesh Shah of Kotak Asset Management on how the market is now and how do you play it, how do you plan your investments as well. This happens at 2 p.m. today on our social media handles.
Welcome back. You're still tuned into Halftime Report on CNBC-TV18. Well, two stocks that came on my radar, HDFC Life and SBI Life from the Nifty pack. It has been a good week for the insurance companies and stocks as well. So right now as well, both of them at the day's high, surging in how 1.3% higher on HDFC Life, and SBI Life too is surging in trade with gains of around 0.9%. But this week itself, both stocks are up anywhere between 6 to 8%. That's about the insurance space, but in the broader markets, Hindustan Aeronautics is trading under pressure as government has floated an offer to sell up to 3.5% of its over 75% stake in the company. Vivek is joining us with more details on this one. Vivek.
Well, absolutely right. So Hindustan Aeronautics is the stock in focus. In order to meet the minimum public shareholding norms, the government has decided to offload almost 3.5% stake if in case the entire subscription or the entire offer is subscribed. So 1.75 is the base and another 1.75 is the upsize option. Now, when you're talking about this particular OFS, the base price is at 2,450 rupees a share, a 6.5% discount to yesterday's closing price. Now, a couple of important points to track as far as HAL is concerned. We have two brokerages that have reacted to this particular development. First, Morgan Stanley says that this OFS will now go ahead and increase the free float outstanding of the stock price, and it actually goes ahead and removes the overhang as the market, according to them, was anticipating a greater than 5% likely stake sale by the government. Now, what they're saying is that they would be looking to use any stock weakness to add to their positions. Now, another very interesting note that's been written by Nuvama Alternative and Quantitative Research. Now, what they say is that the government stake sale, will lead to an increase in the free float of the stock. HAL is one of the top contenders to enter the MSCI Standard Index, in the upcoming May review. So according to them, the probable cutoff level as far as the stock price is concerned, after the increase in the free float, comes down now to 2,150 rupees a share, and they anticipate likely inflows of close to $195 million if HAL does come into the MSCI index. Very interesting development. Interesting to wait and watch how this plays out.
Take that point, Vivek. Thanks a lot for that. Moments ago, we were talking about the possibility of a breakout on the upside. Well, it perhaps may have been playing out right now. The Nifty Bank is back above the 20-day moving average. It's moved to the high point of trade led by HDFC Bank, and as a result of which, the Nifty spiked to the high point of trade just below that 17,200 mark. So keep an eye out on this. May play out to be an interesting second half of trade. The Nifty just 10 points shy of 17,200. Take a short break, come back. On the other side, we'll put spotlight on loan growth in the banking space in our special segment, Fin Street. $41 points higher on the Nifty, close to 200 points from the lows of today, 150 points on the lows from today. Let's move on to our special segment, Fin Street, where Abhishek takes a deep dive into the exceptional loan growth for the banking sector in the fiscal that has gone by, FY23 that is.
Well, in Fin Street today, let's focus on the loan growth, which has been phenomenally strong for the banking sector in FY23 so far. So for the period ending 27 Jan 2023, credit growth was at 16.3% YOY and non-food credit growth was 16.7% YOY. Let's take a deep dive into what has driven the loan growth and how will it pan out going ahead. Incremental loan growth, non-food credit for FY23 up to Jan 2023 has been at rupees 14.6 lakh crore. Monthly basis, the credit demand for up to Jan 2023 has been around 1.46 lakh crore, which is better than the previous high of 1.4 lakh crore that we saw in FY20 and one of the best in many years. Now, which sector has driven the loan growth? Personal loans, which includes home loan as well, has been one of the biggest drivers of loan growth in FY23 so far. Services has been the next best segment to witness strong loan growth momentum. It formed around 31.5% of the incremental loans in the system up to Jan 2023. Agriculture formed around 12.1% of the incremental loans, with industry forming around 9.4% of the incremental loans. Now, talking about the best performing segment, personal loans. Of the incremental loan growth of about rupees 5.7 lakh crore in personal loans, it was around 35.55% share, which has been driven largely by the housing sector, which includes priority sector lending as well. And second large part was from another personal loans, which contributed around 30% of the incremental loans. Vehicle loans and credit cards have done well too. Credit card performance in FY23 so far has been one of the best in the history for banking sector with respect to outstanding loans, card issuances and massive increase in ticket sizes as well. Now, services sector performance has been good too. NBFCs switched to banks from money market as liquidity dried up over there and money market rates also shot up. Trade also performed a substantial portion of the incremental loans in the services segment. Shipping witnessed a decline in terms of incremental loan flows. Let's take a look at the outlook. So loan growth rate will soften a bit going ahead. Some part of to increase, we may see some impact on loan growth as well. Capex demand is yet to come back from the corporate sector. It may not be back in a high inflation rate scenario. Corporate loans may continue to see working capital kind of demand from lenders due to better interest rate than money market instruments. We can expect personal loans to continue driving the overall loan growth momentum for the banking sector. NBFC demand will remain healthy due to favorable interest rates from banks than other instruments.
Okay, that is about the loan growth scenario in the banking sector. With that, we'll slip into a short break. On the other side, Manisha Gupta will join in with Kunal Shah, Head of Commodities, and Nirmal Bang Commodities. Stay tuned for that.
Welcome back, and joining us on the show now is Kunal Shah. He's head of commodities at Nirmal Bang. And Kunal, thank you so much for joining us. And the markets have reacted to the 25 basis point rate hike from the US Fed on expected lines. The commentary also has been slightly dovish. Is the reason we've seen that sharp decline come in for the dollar index? First of all, on the dollar index itself, what's your sense on that number going on?
I think it's very interesting, going forward, what is going to happen from the inflation point of view. Because inflation so far, whatever we have seen the downside, so far it has got no support from the housing. So housing prices and housing rent, which accounts for the major constituent of the inflation, is still not down, and in fact it has been moving up. So last month also, the major reason why inflation did not go down significantly was the housing. So now after the steep hike from 0 to 5%, I'm expecting in next 3 to 4 months, the housing prices and the rent in US to cool down going forward. And that will bring down inflation quite drastically. So I'm pretty bullish I'm very bullish about the prospect of the other currencies, and I'm expecting dollar index to weaken going forward. This kind of tightening should not continue for a longer period of time. The bond market of US is clearly expecting that. So perhaps 3 months down the line, the dollar index will be much lower than where it is right now. I'm not expecting these levels to stay for a longer time. Dollar index is going to go below 100. That is my understanding. And the dollar index is going to weaken. So that's the overall outlook on the dollar index. And that should lead to appreciation in all the emerging market currencies also going forward.
All right. What also could actually appreciate could be commodities, would you say, Kunal, especially the precious metal space. With the dollar index, as you said, if it continues to slide, and it is trading at a 7-week close right now, what kind of support do you see then coming in for the precious metal prices?
Precious metal prices are going to go up quite sharply. So I have no doubts in my mind. It is a strategic investment at this point also. And I'm expecting gold prices are going to go much higher in next couple of months. I'm not talking about years. So in a span of 3 to 4 months, we are going to see gold going to test, perhaps $2,100, $2,150, these kind of levels. And I'm very bullish on gold and silver. 2 reasons. Looking at the way whatever is happening with the Fed. Okay, so Fed, whatever Fed has done right now, what they are saying that they will be hawkish going forward, maybe a rate hike, but I don't think so. They can no longer remain very hawkish. The data points, the inflation in coming months is going to cool down. The labor market is going to deteriorate going forward. And that will lead to a complete U-turn of Fed maybe 3 or 4 months down the line. So I'm expecting, by the end of the year, maybe there'll be a rate cut rather than a prolonged rate hike. And this kind of steep interest rate hike is definitely going to cause some of the other damage in the US economy and elsewhere. So we are going to see a pause in next 2 to 3 months, no doubt about it. And inflation is going to go down in US, not to the 2%, but even 5% or 4.5% would be quite decent number for Fed to say that, look, we've done a great job, and they might change their stance. So precious metal looks very bullish. Central banks themselves are buying gold. So why we should not? There is no reason why we should not buy gold in such kind of times where the geopolitical tensions are heightened. Maybe Russia, Ukraine, China, US. So I think this is the right time to buy gold. Even though it is appreciated by 7-8% in a matter of last 1 month, I continue to see more gains coming in for both commodities.
Oh, well, yes, this is one of the asset classes which has actually given you a good positive return vis-a-vis the other asset classes which actually have given you negative returns in the last 1 month or this year till now. Kunal, what about the base metal prices? Because even as you said, gold is going to go up. We understand that. Silver, which is half industrial metal, also is expected to do well. But the industrial metals itself haven't done so well in the last 1 month.
Industrial metals is a complete divergence of policy. China, which remains the key consumer of industrial metals, they are continuously infusing liquidity. So in last 2 months, 3 months, almost 3 trillion RMB has been infused in the markets in the form of rate cut and in other forms. And on one side, the West is continuously, going after the tighter monetary policy. But metals demand is basically coming out of China. So I don't expect any major infra boom or housing boom in China, which leads to which will be leading to moderate demand growth, and supply side is going to get better going forward. So I'm expecting, going forward, metal prices may correct in next 1 or 2 months, but maybe during second half of the year, we may see recovery. So next 2 months, I don't see any major appreciation coming in industrial metal prices. But in the second half, I'm expecting metal prices to gradually grow up because of the weakness of the dollar more than the strength of the Chinese economy. So right now, still not very bullish. After 2 months, we are going to see a rally restarting in metals.
All right. Kunal, also, what's your sense on the energy markets now? Because after 12% decline in crude oil prices in the previous week, even with the choppiness that we've seen in last 2 or 3 sessions, we are 4% on the higher side for this week for the crude oil prices. At $75, $76 per barrel, what kind of strategy would you make? What's your sense on prices for a longer term as well?
Well, in oil, if you see what is happening, the Russia's production is moving up almost 9.9. You look at the US production, it's almost up by 6 lakh barrels from the start of the year. So 2 major producers of oil are producing oil quite rapidly. And the demand growth, if you look at, I'm not talking about the recession, but with whatever happening across the global economy, the demand growth have remained muted. So even from the China, even that reopening trade had led to some demand, some spike in oil, but post that, we have not seen any major action coming in. So I'm expecting, Brent to floor a bottom around $68 to $70, and WTI, whatever downside we saw during the banking crisis last week, that should be the bottom. It should not go below 64, 62. And I see a very range bound to moderate upside kind of scenario where WTI can edge up to again 75 to 78 and Brent can edge up to 80. So 68 to 80 would be the range for the Brent, and 66 to around 78 should be the range for WTI. No major action expected from these levels. I'm expecting some recovery.
All right, some recovery from these levels. Not sure how the Indian markets would take that. Manisha, Kunal, thank you so much for joining in. For now, things are looking good. We had an announcement on the dividend coming in from IGL as well. 10 rupees per share is the announcement that they've made, the second interim dividend for FY23, that is. With that, we're out of time on this edition of Halftime Report. Stay tuned. Business Lunch comes up next.